Sebali and I'm glad that you're joining us at this top of the hour as we get to digest matters concerning the financial markets here in Uganda and in the realm of East Africa. Remember, the show airs every Monday, Wednesday, and Friday at exactly 9 p.m. Please make sure you don't miss it. You can follow us on X and get to give us some feedback. Also comment on our YouTube channel, that is at Smart24 TV Live, and you'll be able to definitely get your feedback through, and we'll be responding to some of your questions and concerns in as far as the market is concerned. Now, just to delve right into the discussion, tonight we have a very special discussion, and we are talking about treasury bonds and treasury bills. If you are an investor, of course a seasoned investor, you know about these products. And if you're not, you probably have lots of questions. Probably you have had, but you haven't understood the difference between treasury bonds and treasury bills. How can I access them? Where do I find these bills and bonds? And then, of course, how do I be able to benefit? What are the potential benefits of investing in such asset classes? Now, joining me on set tonight to discuss this and more is none other than Mr. Andrew Mwima. Mr. Andrew has been on the show before, and he has a wealth of experience trading in financial markets. He spent 10 years up to 2023 January actually being a manager in charge of trading and research at the Uganda Securities Exchange for the past 10 years. You can imagine that much experience. Now he's into private practice, and he's still, of course, a financial markets expert and consultant. You're most welcome to the show.
Thank you, Anthony. Greetings, viewers and listeners. It's a pleasure to be back.
I hope I massaged your ego well enough, because you're a man of a very great experience, and I have to say we are very honored always to have you here.
Yeah, and I never take it for granted also. Thank you for inviting me once again to share my knowledge, because I give the audience at least that perspective as a practitioner. I've had the privilege of seeing what people do, but I've also invested in financial markets. So I believe when we share this knowledge, a person who is at crossroads can easily make up their mind to start investing.
Wow, amazing. Just to have a sneak peek into what a treasury bond and treasury bill is, I understand we have different sorts of viewers. Some people have heard of it, others have misconceived it to be something to do with investing, for example, in a stock, and some people don't entirely understand. So could you break down for us what a treasury bond and treasury bill is?
Yeah, thank you, Anthony. To our listener out there, a treasury instrument is actually a debt by the government, where government is trying to borrow from the public. It can borrow for a short period of time or for a long period of time. If government borrows for 1 year, 6 months or 3 months, that's short term. It's what we call a treasury bill. If it borrows for a period beyond 1 year, in Uganda, the tenors are 2, 4, 5, 10, 15, 20, up to 25 years. That's what we call a treasury bond.
Up to 25 years?
Up to 25 years.
That's the maximum in Uganda?
Yes, in Uganda. Now, government does this for a series of purposes. It could be for monetary policy purposes or fiscal policy. To simplify the English, government usually towards the end of next month, we shall be hearing the budget. Government is trying to fund a given expenditure. So part of that money comes from people like you and me, from NSSA, from banks. Those are what we call the domestic market. So it could be to pay doctors, to pay teachers, to build roads. If government gets that money from the public, that's where the treasury bills and bonds come in place. So it's a loan, meaning that government will need to pay back. So the name of the interest rate which government pays back is called the coupon. And unlike the ordinary loans which we are used to, where we have to pay back interest on a monthly basis, In this case, that coupon interest is paid back biannually. So every 6 months, government will be paying you interest.
So just not to lose our viewer here, you have a government which is running different all sorts of services, social services, and they need money, and this money probably they will get it from borrowing either in foreign countries, or they can borrow domestically.
Yes.
And these treasury bonds and bills are ways that government actually gets to borrow.
Yes.
And now you're talking about a coupon. Could you expand on that? Because what a coupon comes to me, when you talk about a coupon, what comes to me is an interest,
Yes.
right?
Yes.
So what makes the difference between a coupon and the interest that we know from the loans that
Actually, it's just the name which changes without us overcomplicating things. Typically, when you borrow from a commercial bank, you're expected to pay back some money regularly. In Uganda, most cases, it's on a monthly basis, maybe after you've received the salary. Now, the name simply changes where government is involved. The interest they pay back to its investors, it's what we call a coupon. Just like we have been speaking in the past, a person who invests in stocks expects a dividend. We are just speaking about CIPRA, about MTN, companies which have performed excellently, and they are willing to share part of that excellent profitability with the shareholders. So the investor in bonds expects to receive what we call a coupon, and at the end of the maturity period, they return back the principal to you. Yeah.
Let's talk about the process. Now, you have mentioned earlier that you have these instruments, or to simply put them, assets, if I could put them so. You have these assets that government borrows at a certain rate, which is called a coupon, and that rate is actually what the investor is getting back, right? Now, let's talk about the process. Where is the auction? Because we know there's an auction probably during these bonds and bills. Where is the auction? How do I participate? And where do I start when I want to invest in treasury bonds and bills? What do I need to know?
Okay. Very interesting questions, Anthony. Now, in the financial markets, we have what we call primary and secondary markets. Still, you will allow me to relate to that example of stocks where here this company has done an IPO, an initial public offering. That's when the company is coming to the market for the first time. Now, the case with the bond market, the treasuries, the government of Uganda, typically every 2 weeks, it has been coming to the market either to issue a fresh instrument or to do what we call the openings.
Every 2 weeks?
Yes,
Wow.
historically.
That's for bills?
Yes, both. We shall mix,
Okay.
It really depends, but historically there has been that culture where the government comes to the public every 2 weeks to issue either a fresh instrument or to reopen. That's what we call a primary market. And they have gone as far as issuing a calendar at the beginning of the financial year. You will know that between July 2024 up to June 2025, these are the bonds I will be able to participate in or to buy. These bonds also have some unique features. They have names. We call them ISINs, International Securities Identification Numbers. So you're able to tell they will be issuing.
Which kind of bond will be issued when?
Exactly. Right. It has a number which specifies its maturity, the interest or coupon you receive, and features
now
like that.
Into those terms, maturity. Some of our viewers are not that mature financially to understand.
I understand. But for our listener out there, just know that a treasury bill and bond has a name. That name has a complicated attribute which we call an ISIN. But later when you engage with experts like us, we can simplify it for you. So that is the calendar. As an investor, you will be able to determine between July and June next year, these are the instruments which government will either be issuing for the first time or reopening. Now, when you miss those windows, it does not mean that you cannot invest. That's where the secondary market comes in. It means that as an investor, you can now buy from the people who participated in the primary market. That's what we call the secondary market.
Amazing.
How do you go about the process of investing in treasury bills and bonds? You need to open an account. We shall call it a trading account, but the technical name is a CDS.
So number one, you need to open an account.
Yes.
Right.
It's not a bank account, but it's what we call a CDS, Central Depository Securities Account. It's free of charge. Unlike the bank account, it never attracts charges, it never goes dormant.
Yeah.
For you to get that account, you need a national ID, a copy front and back. You need a bank account, of course, because when they are paying you back the coupons, you do not go to Bank of Uganda and say,
Where my coupon?
yeah, a year has ended, my treasury bill has matured, give me. So they wire that money on a bank account. Then a photograph. Yeah, a photograph. It's as simple as that. Then there are some minimums. You need at least the bare minimum. Yeah, so that is the process. So it's a must. You have to fulfill whether you're participating in the auction or on the secondary market.
All right.
Yeah.
Then let's talk about, first of all, the maturity. You mentioned the maturity, and I don't want to lose any of my viewers here. What is the maturity of a bond or a bill?
Yeah. Now, a maturity is another simple word for a term. Remember, when you go to a bank to borrow, you will specify, I'm borrowing for 2 years. I'm borrowing for 5 years, 10 years. That is what we call maturity, the term, the tenor. The name simply changes. So in Uganda, our treasury bills start from 3 months, 6 months, and 1 year. That's the maturity of the treasury bills. Then, like we discussed earlier, 2 years up to 25 years, that's the long-term maturity, and it's what we call a treasury bond. Now, for us who have experience, there are sometimes what we call treasury notes. They are simply mid-term, 2 to 5 years. But for purposes of our audience, anything that exceeds 2 years is what we call a treasury bond.
Okay.
Yeah.
So treasury notes are bonds that have a maturity between 2 years
And
5 years. Do we have bonds of 2 years?
Yes.
We do have bonds of 2 years. Okay. And that's, I think, the minimum.
Yeah, for the treasury bond.
For the treasury bonds.
Yes.
Perfect. Now let's talk about we've seen the auctioning process. You've talked about the fact that if I'm going to open, whether I'm going on the primary market or the secondary market, I need an account, a CSD account, and to open that account I need a national ID, a bank account number, and a bare minimum.
Yeah.
Let's talk about the primary market in detail. Who goes to the primary market, and how do they go there? How do they get there? Because I'm pretty sure it's not like going to Bank of Uganda and walking in and saying, I need this bond. How does it work?
Okay. Thank you, Anthony. For our listeners out there, I know we are in a society right now, and I love this habit where people are part of circles, people are part of investment clubs, and some kind of institutional investment group. You can participate in auctions as an individual and as an institution, meaning Anthony and Andrew, we can buy these bonds. If we are part of a group, if we are privileged to work in a company which has a provident fund, a circle, they can also participate. Yeah, beyond that, and maybe the requirements for the institutions differ a bit. There you need to identify who are the signatories, you may need a constitution, you may need a certificate of incorporation, and maybe a tax identification number. just to show that you're compliant. So the requirements differ a bit if you're participating as an institution, simply a non-individual.
Okay.
Then we have what we call the bids. When you come to these markets and you want to buy, we call it a bid. We call it a bid. When you're trying to sell, it's what we call an offer. That's why you see the auctions actually. If you're to read the newspapers, the New Vision of Wednesday, you see tender, then you see an offer, meaning that government is selling the units. That's the offer. Then you who is buying, it's what we call a bid.
You're bidding.
Yes, you're bidding.
Absolutely.
Now, if the amount of money you're going to use exceeds 200 million, that's what we call the competitive bid. Then if it's below 200 million to 100,000, it's what we call the non-competitive. So there is something for everybody. If you have little, you can participate. If you have much, you can also participate.
Let's not lose our viewers here. You have two kinds of bidders, the competitive and non-competitive. And you're saying for competitive bidders, you need at least 200 million shillings.
And beyond.
Wow, those must be the big boys. And then for non-competitive bidders, is there a minimum amount?
Yes,
What's
the minimum is 100,000.
100,000.
Yeah, but the reality with these fixed income instruments, the bonds, it's a game of numbers. Typically, the person who puts in more must earn more compared to the one who puts in little.
You reap what you sow.
You reap what you sow.
Absolutely.
Yeah.
What are the different roles of these bidders? Because when you talk about competitive, sounds like to me there's some bit of competition there. So what do the competitive bidders do that the non-competitive bidders don't get to do?
Interesting question, but nothing outside the normal, really. But what an economist or person out there calls economies of scale. Sometimes when you're using much, the person who is offering may give you fairer terms. Now it could be a slight increment in the rate, assuming maybe you're meant to receive 18%. Somebody can mark up and add you an extra 20 basis points, which can be 18.2.
Yes.
Yeah, so those are some of the benefits which you enjoy, but nothing typically outside the usual. It's just that sometimes people prefer dealing with those who take up a larger chunk of the cake when they are offering.
Of course, people want to be close to the big boys.
Yes, yes.
But then also, how do you determine this coupon? Because at the end of the day, I've seen, for example, when you open the Bank of Uganda website, you have a rate. But there are two rates usually. There's that rate for the primary and then the secondary market. And usually those rates are different. How does that work? How come the coupons are different? Yes.
Yeah, now in Uganda these days, the rates which you see in these primary markets are market determined, meaning that it's actually not defined in that initial prospectus when they are offering you this instrument for the first time, but they will allow these participants, especially the competitive, these are the banks, the large pension funds, to kind of gauge, they weigh the factors of demand and supply and gauge with this instrument, depending on its tenor, the maturity. The demand side, they will be able to, maybe they are comfortable with the rate of 18%. No. That's how the rates are determined in the primary market. Then when you go to the secondary market, that one it will typically be how the day has fared. The bond market is active Monday to Friday, I believe from 8 up to around 4 p.m. Now in there, depending on the economy, depending on the foreign interest, depending on inflation, etc., people will drive the rates a certain direction, meaning it can go up, it can go down. So that will determine on the day and the developments at the central bank and
Yes,
maybe the strikes, the political environment, etc. etc.
And I also want to stay with you on this one. The primary market offers, these instruments to competitive and non-competitive bidders. And you mentioned earlier that for you to go into the secondary market, it will be up to the primary market holders to be able to sell to you.
Yes.
Right?
Yes.
So these initial holders, let's say the primary market investors, what if they hold their instruments and they decide not to sell them? Does that mean that the secondary market is doomed?
To some extent, by the way, assuming a particular instrument has a face value of maybe 500 billion, and that instrument is only held by one large pension fund, one commercial bank, so they actually have the liberty to withhold. Withhold. But remember, every time there is scarcity in supply, it means that the demand will be higher. Assuming they got it at maybe 17% and they are not willing to bring it back, and the person who needs to enjoy the benefits is willing to increase to 20 to 22%, it can be an inducement for the person who got in the primary market to offer it.
So these primary markets, as they go into the secondary market, are they the ones to determine their own coupon or the interest that they must take up?
I think interest is the best, would be the best word here. Yeah.
Yes, because now you're having, they are receiving their coupons, because I believe the holder of the instrument receives a coupon, right?
Yes.
But then I can decide to sell this instrument at a specific rate.
Exactly.
So that's what happens.
That is what happens. The coupon is a little bit defined. You can actually know it's already defined. But
so you can know from a given bond that I expect this much coupon, and that won't change.
Yeah, typically it won't change. It's the interest which is susceptible to the market forces of demand and supply. And that's why you may hear things like interest rates have reduced, bond prices have increased, and the opposite is also true. Wow. That's where it comes from.
Right there, Mr. Mwima. I'm loving the conversation, and I'm sure our viewers are as well. We're going to take a quick break. But when we return, we are going to talk about those interests. And our viewers, there are two different things. There's a coupon and an interest. And interestingly, he has just defined the difference. The interest is what you gain from selling from the primary market, moving into the secondary market. The coupon is a constant that comes directly from Bank of Uganda as a result of holding that instrument. I think that's a very key piece of information. And when we return, I want to still know about something called the yield. There is a yield. And we hear all these, we look at all these curves on Bank of Uganda website, and they say the yield is up. Are yields similar or synonymous to interests, or there's something else? And then there's also an interbank sometimes that comes into the picture. Every time you see that graph with the yield, you also have an interbank rate. What does that mean? Then also, we're going to talk about the role of dealers. There are dealers, the so-called dealers, and also the tenors. What is their role? And what are these different terms, and what do they mean? My name is Anthony. I'm with Mr. Andrew, and we are discussing treasury bonds and bills in details. Don't touch your dial. Stay with us. This is Smart 24 TV, where we drive your business.
Smart 24, driving business.
You used to tell me that I don't make you happy. All that time you would be complaining. I'll call you every day, yeah yo, baby don't know.
You can now get all the Chibuzi out with MTN voice bundles. Call all networks. Kubei Dondoro. Buy a 25-minute voice bundle for only 1,000 or buy any daily voice bundle of your choice. Dial *100 *21 hash and select daily or use the My MTN app. When we talk together, we are unstoppable.
Amanya gange bampita Agnes Kasoga. Kolera nakawa nze muwanguzi nawangudde school fees. Nawadde simanyi ebintu bino bya ddala kubanga neyankubira namulimba nnyo ne mugamba nkolera nakifuma nga manyi bafere olwamala ate naddamu nankubira ne mugamba ekituufu sikolera nakifuma badde manyi muli bafere nga simanyi bya ddala nalabirawo nga baŋŋamba ndi omu ku bawanguzi naye nsanyuka nnyo.
Akalulu k'omuwanguzi!
Okuwangula kyangu nnyo, teeka ssente ku ssimu yo otandika okusasulira ku ssimu yo. Abantu mbakakasiza era nabagambye bwe mulaba nga bampadde ne mbagamba nga mutegeera bituufu kubanga nange mwennyini mbadde nga ku TV nga mmanyi balimba naye ke neerabiddeko bwe nti kyekyo ddala kyekyo MTN osobola okuwangula.
Together, we're unstoppable.
Crazy guy. I'm going to go crazy. Flavors of Africa.
Enjoy your favorite shows anywhere. Download DSTV Stream today. Smart 24, driving business.
Welcome back, ladies and gentlemen. Thank you for staying with us. And this is Smart 24 TV, where we drive your business. Remember to catch us live on GOTV at channel 394 and DSTV channel 372. But also you can catch us online at our YouTube channel, that's at Smart 24 TV Live, and give us those comments and questions. We shall be very glad to answer and respond. Now, we have a discussion in the house tonight on treasury bonds and bills. These are instruments, we've already defined them, that are traded on primary and secondary markets. Now, investors come to the central bank through what we call dealers, and we're going to know what dealers are, and they buy these instruments and they earn what they call a coupon. We've already understood that the coupon is sort of like the earning that comes from holding these instruments. Then we've also seen that for you to be able to access these markets, you must have what we call a CDS account, a Central Depository Securities account. And this one helps you to access the market as well. Of course, to access this account, you must have a national ID, you must have a bank account, and the bare minimum. We've also discussed the primary and the secondary and competitive and non-competitive bidders. So if you've missed that, please first go back and actually understand what those mean before getting into this discussion. Now, Mr. Andrew, just to proceed, very well, you've talked about the interest, and I've loved your explanation. It was so simple and basic for everyone to understand. Some people usually confuse the interests with the coupons, you know, but now we are very clear with that. The interests are those born during transitioning from the primary to the secondary market, and then the coupon is a constant that is earned by anyone who is holding that particular instrument. Let's talk about first of all, where the yields come in. There's always something to do with the yields. Are the yields similar to the interests, or there's something else?
Thank you, Anthony, and once again for the people listening to us. Yields are actually relatives of interest without using too much financial jargon. And recall that these bonds in particular have a component of a cash flow. Then they have a component of time. Time which we call the tenor, which we call a maturity. If you're to look at a bond critically, the value of the bond will depend on the cash flows you're going to receive. So you would expect a long-term instrument to have a higher value compared to a short-term instrument. Now in finance we have something we call discounting. Assuming we are going to invest in a 1-year bond, this will mean that Anthony is only going to receive 2 coupons. One coupon first 6 months, another coupon at the end of the year.
Yes.
But what if Andrew buys this coupon from Anthony after the 6 months have ended? It will mean that I only have one other coupon which I must receive. And I just wanted to use this basic example such that we can appreciate what a yield is. The interest rate we shall use to determine Andrew who is going to buy this bond from Anthony, and other than spend the full year in this instrument, I only hang in there for 6 months. That is what we call the yield to maturity. If I buy this instrument and Anthony has exited after 6 months, and for me I'm coming in between, what will be the value of the cash flows which I will expect to receive for the 6 months which are left? So that interest rate is usually what we call the yield to maturity. So if you're buying a 5-year bond on the secondary market, but you're getting it 1 year after it has already started, it means that you have around 10 coupons to go in addition to the face value. So that interest which will factor in the time which is left, because you're not like somebody who started. That's what we call the yield to maturity. And when you're to look at these curves on the website of the Bank of Uganda, when you're to put a mouse on that curve, it will be able to give you that value whenever you're trying to get in. It guides you on the value which you will get out.
Just to know if I've understood, yield to maturity is because, first of all, let me ask you, do you have an allowance to trade on the secondary market after trading on the primary market?
Yes.
Do people who have bought on the secondary market, can they trade even when, or maybe you have 6 months left for the bond to end or to mature, can they still trade it?
Yes, even if it's
multiple times,
even if it's
trade.
1 week,
yes,
you can get out,
trade,
you
yes,
can get
someone
in.
else moves it.
Yeah, you will notice that a person who was there from the beginning, it should be differentiated from a person who gets in later. So things like yield to maturity help you to differentiate
these two people.
Exactly.
They don't earn the same.
Yes, you can't earn the same.
Is there an interest attached to the trading within the secondary market? When you're trading amongst yourselves, Andrew, you bought in the secondary market, and now you're selling to me in the secondary market, and maybe I have 1 year to maturity. Do you sell to me at an interest? Besides the coupon, do you sell to me at an interest?
Absolutely, absolutely.
Well,
and
so
it's real business. That's why later I know you're going to ask about primary dealers, even the brokers. They are bond calculators which give you an accurate figure of the amount of money you're supposed to pay depending on when you get in. So the experts will actually do all those calculations for you and tell you the interest. Now, other than actually the interest, they will simply tell you
the yield.
The yield, even the face value, that this bond which had this given amount, for you to take it, if it was 10M, maybe you're going to pay 11, something like that.
Nice.
So it's
so this interest bears in mind, or so to say, in quotes, the interest you paid when you were buying from the other person. Let's say you bought from the primary market holder, and then you paid them interest, and now you're selling to another person. You must actually account for the interest you had.
Yes.
Wow.
Even the time which is
left.
The coupons which you're going to receive.
Which this other person is going to receive.
Exactly. So you must compensate this fellow for the opportunity cost. What is going to miss?
Who calculates all that? Do I have to know how to calculate all that?
It's complicated. There are bond calculators. Sometimes you leave the issues of the generals to the generals.
Nice, I love that.
Yeah.
Nice. Now let's talk about the primary dealers. Who are these? And what are they about?
Yeah, a primary dealer is simply that intermediary who buys and sells bonds on your behalf. A primary dealer is very similar to the stockbroker. When you want to buy stocks, it's a broker. Now, a primary dealer is the one who buys and sells for you the treasury bills and treasury bonds. And typically, primary dealers in Uganda are commercial banks. I know you have bank accounts in Centenary, Stanbic, Standard Chartered, DSTV, yeah, Equity, all those are primary dealers.
Okay.
Yeah, just beyond that, buying and selling for you the bonds. This question you asked, I want to buy on the secondary market. What rate should I pay? They give you that advice. Oh, I'm retiring. I've been receiving a salary. I've worked for 35 to 40 years. Where can I invest in order to receive coupons that resemble the salary which I used to receive on a monthly basis?
Yes.
These primary dealers give you all that advice. Remember, there are around 66 treasury bills and bonds which are available as we speak, which have not yet matured. So for the listeners out there and you're retiring, did you know that you can put money in 6 bonds and you make sure there is a bond giving you a coupon in January and July, Feb and August, March, September.
Almost throughout the year,
Exactly.
you're having these coupons coming.
Yes, yes.
You're almost on salary.
You're almost on salary.
Yes.
You will even know if on average I need 1 million shillings to live comfortably in a month. What principal can I put in order to receive the equivalent? So these guys give you that advice free of charge. Then there was an interesting question you also raised. The times where people want to buy and nobody wants to sell. When you see a dealer is not an innocent word. It means that these guys know who has the bonds, and they know how to massage them, how to tickle them, and they release the bond. So they will make those calls on your behalf. Hey, this bank or this pension fund, I have people who can give you good money in that bond. What rate would you be willing to take? So they have all those discussions. That's what a dealer does. Then they get for the people who want demand to get at least a piece of that bond. Then we have something called market making. Market making, there are cases sometimes, though it may not have happened in Uganda, there may be people who want to sell, nobody wants to buy. So these people usually take up the contrapositions. If there's nobody willing to take the risk, they will be the other counterparty. So they buy when everybody is selling, or sell when everybody is buying. It's also a very critical role.
The counter.
Yeah.
What is in the market?
Yes.
Yeah.
Such that the market keeps liquid. It keeps active.
Stimulated.
Yeah. That's why it's not every bank that is actually allowed to maybe take part in competitive bidding. They could have left it to only a few because of that core role.
Oh,
yeah.
That's very interesting, you know, and I think it's very valuable information for our viewers here. Some people, you know, right now they are receiving their NSSF benefits, and they don't know, they have no idea where to put it, and you know, there are all these sorts of young people, especially, who are telling them going to forex trading, going to cryptocurrency. You know, we have so many things happening right now, and they are promising high returns. But then such a venture could be one of the best, if not the best, actually, because you're dealing with, first of all, licensed people, legitimate dealers, and people who are being trained and know what they are doing, and promise at least security for your money. I think that's a very important discussion, especially to hold with those that are receiving their retirement benefits.
Absolutely.
Now let's talk about, still talking about these dealerships. The primary dealer's role in the market, does it only apply to the primary market, or it applies to both? The primary dealer can be in the secondary and the primary market.
Actually, it cuts across. Yeah, in the primary market, they will help you participate in the auctions.
Yeah.
Secondary market, they will be that thing we mentioned, the market making, the contrapositions, offering liquidity. They will be there to buy and sell for you when you have missed out. And the beauty with these treasury bills and bonds is liquidity. Whenever you want to exit, just call your primary dealer, your commercial bank.
Who is burning to get in.
Yeah, they will do it for you. Wow. You get your money, sort out your problem. When you get another windfall, you get back in. They will handle all that for you. That's on the secondary market. Yeah. And like we hinted also, earlier, advice is key. I know for the people listening, we usually get excited. A treasury bill, a treasury bond, we imagine it's gold, but it's something that needs time to understand and to comprehend. That's why some of the words I was using were heavy. Now these guys simplify it for you. I'm selling now, what price should I get? The primary dealer will do all that for you. That's why they are critical.
Well, I've had people say that amongst all the capital markets asset classes, treasury bonds and treasury bills are the safest. I don't know how true that is, but also some people have claimed that they are 99.9% risk-free. What would you comment about that?
It's an absolute fact. For fixed income, even when you're to compare real estate, equities.
Wow, even real estate?
Yeah, even real estate. Even to some extent gold. But it's debatable. But the treasury bills and bonds are the safest bet for an investor. Why is that the case? The government is going nowhere. Governments do not change. I like teasing the people I train time and again. When we were in secondary school, that's in the early 2000s, 98 and to the early 2000s, they used to say some of us were still paying the debts which built the Owen Falls Dam, built in the 40s and 50s. The debt burden on our children and grandchildren, they may still be paying debts for the mistakes we made in the past, 60 to 70 years ago. So governments never change. Then government has a lot of alternatives. It can undertake in order to pay back to a domestic borrower. Things like printing money. Anthony, if tomorrow they tell you that Mr. Atingi Ego and his team, they have paid you a bond, will you say, that note is too new, they have printed?
Yes.
You take your money. You take your money.
So they would rather print money
exactly,
than default.
Exactly, than default. They can even borrow from the World Bank and a number of these
to be able to pay
you back.
That's how much they respect.
That's how much the alternatives they have. I know a few months ago, many of the businessmen and women are crying, URA, taxes are becoming taxes. I know we also feel them. But that is government trying to get expenditure in order to pay you, rather getting money through the taxes in order to pay you. So all those alternatives make investing in government securities safer. It's not a case with a listed company, a listed stock, or a company which is selling a corporate bond. It can't do that. For it has only to perform well, maybe cut costs in order to pay its investors.
That's actually very, very interesting. You talked about, you compared them to fixed deposits. Maybe if you could, just before we wind down, just break for us down the other options that are available to invest in besides treasury bonds that you could say the treasury bonds beat at safety. You've talked about fixed deposits. There's also something called commercial papers.
Yeah.
There's something to do with corporate bonds. Talk about these other asset classes.
We shall start with the stocks. These bonds themselves are good. Why they are good? That safety in itself gives you stability, it gives you protection. That is why it's a strongly recommended asset class for our people approaching retirement. Even for those who are very risk averse. You lose 5,000 shillings and you feel bad.
You lose the bonds.
The Gandas, I think, say, and you get out of Mbera.
Yes.
Bonds are good for you. But that is also not the best all the time. For times of growth, when you have a lot of time, when you're young, you have risk with you. Meaning that if you lose money, you have some time to recover. The stocks sometimes give you the best growth. I've been here a number of times. I've shared examples of stocks like BAT, which 10 years ago when I was joining the exchange were as low as 600 Uganda shillings. Right now it's at 15k. Meaning a person's money has actually grown. Capital gains alone in excess of 2,000%. So stocks give you that growth because of risk. The higher the risk, the higher the return. Now, if you choose to invest in commercial paper and corporate bonds, here you're simply lending to a company. When you lend to a company for a short period of time, it's what we call a commercial paper. Like we saw the other side, 6 months, 3 months, and 1 year. Then you're lending to a company.
Like, in quotes, giving a treasury bill to a company.
Exactly.
Yes.
Yeah. Then if you're to give a company a long-term loan, it's what we call a corporate bond. The way these commercial papers and corporate bonds are structured, the interest rate they pay you, they actually benchmark using a treasury bill or bond of the same maturity because it's risk-free. So they will add a premium for maybe liquidity, for default. So if a 10-year bond is giving you 15%, the corporate bond may give you 17%. So those are some of the dynamics. Then fixed deposits, here you're simply lending. You rather give your commercial bank money and you allow them to lend it to others. Exactly. So it will depend. They have the liberty to determine what interest rate they will give to the person who they are lending to, and what they give you. It's really up to them. There is no defined standard that start here. Then there are what we call unit trusts, collective investment schemes. I like using a simple example. A unit trust is like a balanced diet. You're eating a plate of katogo with maybe posho, with dodo, with meat, fruits. Now a unit trust pulls money from different investors. Some of that money is invested in a treasury bill, in a treasury bond, in a stock, in a fixed deposit. So you find all of these instruments on one plate. So 100,000 is good enough to do a treasury bill or bond, but 100,000 in a unit trust allows you to literally have everything.
In one basket.
Yeah, in one basket. So the biggest advantage I've observed with these unit trusts is in the times of emergencies, you're earning some interest daily, but when you try to call your fixed deposit from a bank, you will be penalized. They will slap you, penalize you, etc. Unit trust, you give them a call at 9, by 5 p.m. you get your money plus the interest.
Wow. Thank you so much, Mr. Andrew. And now our final question. Our time is fast spent. But our final question, are there any taxes implemented here in the treasury bonds and bills? And if so, where are they charged? Are they charged on the interest, on the coupons? Are there any taxes?
Yeah, absolutely. There are some little taxes, if we may, and it's called the withholding tax.
I think it's unfair. We are lending to government and it's taxing. Okay. But it's okay.
It always feels unfair, but it's a small tax, and it's not on your principal, but it's rather on that coupon which you're going to receive. So if you've invested in a bond giving you 20% per annum, just know that 10-15% of 20 might be around 3 thereabouts. So effectively, you will receive 17%. They withhold part of the coupon which they pay you. But I believe maybe in the future the rates will even come lower to encourage more investments. So the principal is not taxed. You lend to government 10 million you will receive, but it's that the coupon which you're entitled to, where they will decide to deduct something small.
Well, thank you so much, Mr. Andrew.
Welcome.
Thank you, our viewers. Your last words as we part.
Yeah, it's always a pleasure. I never take it lightly to always get audiences to share knowledge with you. I'm on all forms of social media. If you can, if you're to use X, Andrew Mwima with a double I, I'm there. Yeah, if you visit the website of CMA, since they are sponsors of the show, and give them a call, I will also be available. But my phone number is 774-163016. 774-163016. You're an investment club, a group, and you need more knowledge about investments, the things we have spoken about. I'm just a call away.
Wow.
And of course, our sponsors at Capital Markets Authority, they are just a call away to mobilize people like me to assist you start this investment journey.
Wow, there you have it, ladies and gentlemen. That's it from us tonight. And thank you so much for those of you that were on social media, and those that, of course, had some questions. We'll be able to respond to them online. My name is Anthony Sebale, once again, your host. I'll catch you on Friday, same time, same place. Bye for now. Good night.
Smart 24.